this is Angel with Succeed in Finance. It was pretty interesting week on the financial markets, and in this video I'm going to discuss what happened, and in one very interesting scenario that I do expect we can see over the next couple of weeks or even months. So starting from 23rd of March, we saw pretty substantial upward movement, and over that during this time we saw many discussion about that probably this the market is recovering from this pandemic shock on the financial markets. And what happened during this time, it's pretty interesting, because from the point of view of the technical analysis, and especially from the point of view of Elliott wave analysis, wave counting, we saw definitely one 5 waves upward movement. What do I mean? Let's see here. We've got definitely a huge probability that we see here this construction, 1, 2, 3, 4, 5 waves. All the rules were completed that this could be true. What do I mean? The second and the fourth wave should differ. They cannot be pretty much the same. So in this case, we see here that as a construction and downward retracement, the second way pretty much differ from the fourth way. But where is the problem? The problem is that this entire construction pretty much look like a terminal. What do I mean? Some of the analysts discuss this figure as a diagonal or ending diagonal. What do I mean? Let me point out here and here. So what is specific for this type of figures? Usually it is not pretty much usual to see this figure in the beginning of an impulsive construction, because with this definitely could be considered as an impulsive way. And if we expect this to be first way from the entire recovery from this downward movement because of the pandemic, it is not so usual this to happen in the first wave. But you know, always there are exceptions. It is interesting, especially in S&P 500, that this upward movement succeeded to retrace 61.8 Fibonacci retracement. What do I mean? Here we see that the index succeeded to go above this 61.8 Fibonacci retracement, which showed up as that the market is pretty strong. In other words, the confidence among the investors and traders is a bit strong. But on the other hand, I would like to discuss if this is the real scenario. This is something that we are going to watch over the next couple of weeks or even a couple of months. If this is the scenario, what the traditional technical analysis, and especially Elliott wave analysis, says about this type of figures. Diagonal or terminal, according to the Glenn Neely's terminology about the Elliott wave counting on the financial markets. If we see this figure, I mean ending diagonal or terminal figure, we most probably we can experience after that, and in a short period of time we can see a retracement or going back movement in a pretty short period of time at about 80%, or even the entire upward movement could be retraced. What would that mean? If this is really happen, it will mean that we could definitely expect some kind of down movement that is going to end up about this, somewhere about this level, 2400 in S&P 500. As I said, there are slight difference between S&P and Dow Jones, because Dow Jones didn't succeed to reach 61.8 retracement. Okay, if this is the scenario, because this is not the only one scenario from the point of view of Elliott wave, counting on the waves on the financial markets and the indexes. This could be also just the final upward movement could be only the beginning of an extended fifth wave, but following the rules, this is less likely to happen. As of this moment, this is really this figure really look like a completed five-way upward construction, and most probably, if, as I said, if this is the case, we can expect a substantial downward movement or correction from this month. If this happen, we can expect that we can see something like a double bottom. You know, always you've seen probably they are discussing the so-called V-shape recovery, which means short within a short time period, quick recovery from this recession, because this is really a recession. This week were published the data about the GDP, and you saw there was 4.8 in GDP in the negative territory. This is a really recession. You know, the definition about recession is actually 2 quarters of negative growing of GDP. So what would be really supporting for this type of scenario? We saw this week there was again data about the jobless claims, and officially we've got already more than 30 million unemployment. You can see on this chart that this is in compare with the recession in 2008 and 2009. You see how how much was the jobless claims and what is right now. It is really devastating, and this recovery, it appears that it will be not so easy. From the point of view of the traditional technical analysis, we can see also some different features. First, this initial trend, upward trend, here it was broken from above. It was broken, so it was the first signal that at least this upward trend is slowing down. And from this moment on, this trend line is used like a resistance level for the investors and traders. And also, if we move this trend line at this point, this week, actually yesterday, it was also broken down, which could be also used as a signal for the short-term traders to start selling. You know, they have their point. So this is just my opinion. Once again, it is not some kind of advice. Please read the risk disclaimer. But from my point of view, this is there is a huge probability this to happen, and we can expect over the next couple of weeks a substantial downward movement, which of course can be used from the investors and traders to start buying from more attractive levels. Okay guys, thank you for watching. If you haven't done this yet, please subscribe to the channel and hit the like button if you see a value in this video. Thank you. See you next time. Bye bye.